Hello everyone and welcome to this Demica webinar, Q1 Insight 2023. Thanks very much for joining. And before we get started on the content properly, I'm going to go a few housekeeping points so you know how to participate in today's event. You have all joined using your computer audio, and as you heard from our brief echo there, we are also using computer audio. Hopefully no more technical glitches. You're all in listen-only mode, but we would really encourage you to submit your questions as we go through the event to engage with the speakers, challenge them on some of the points they're making, and we'll address those questions. Maurice will moderate those questions at the end of the session. Finally, the webinar is being recorded. And all attendees or registrations will receive the recording within 24 to 48 hours following the webinar. With that, I'd like to hand over to Maurice to begin the webinar proper.
Thanks a lot, Dan. So I'll start with some introductions. We're really fortunate to have with us today Stuart, Brister, and Eric Lee. So Stuart is the Executive Vice President and Head of Global Trade and Receivables Finance for Wells Fargo. So a powerhouse in the space in the North American market and beyond. And Eric Lee is the head of competitor analytics at Coalition Greenwich. We're delighted to have Eric with us because, of course, Coalition do their own research. They talk to many of you and to much of the market. And so Eric will keep us honest in terms of the results of our survey and some of the points that we want to go into in depth. So thank you, Stuart and Eric, for joining us. We've had our HSBC panelist has been caught on a last-minute flight change, so we'll be catching up with him separately, and I think broadcasting that under separate cover. So without any further ado, let's get going. So I think what I'll do is to start on the to give you just a little bit of context on the survey, just to remind you for those of you who are new to it. So we went out to a broad universe geographically of banks, mainly banks, across the world. We received around 195 respondents from around 150 banks, and the audience are working predominantly in the supply chain finance and securitization space. And they're focused on the needs of large corporate multinationals. So consistent with the profile of our business, there's less of an SME focus on the results. It's more focused on the clients of a typical trade team or securitization team. So just to move on, giving you an idea of the audience makeup, you can see that predominantly front of office are product managers, specialist sales folks, structurers, within those teams, but also with some representation from the technology operations functions, because if we look at what we've tried to learn from the market, it's been what's going on from a product perspective, and obviously that is a combination of front and back of house. How is growth playing out? How has it played out and is playing out over the kind of next 12 months? And then what are investment plans when it comes to technology and more broadly in terms of head count. So that gives you kind of a brief outline as to the audience that we took the data from, and we'll move now into some of the insight, get into conversation. So yeah, people. And I'd urge you, please, as we're going through this, if there are, if there are items that you agree on, disagree on, and have opinions, post them in the chat, and we'll try and build that into the discussion. But if we move on to the first point on people, and this is something that as a theme interests me a lot, and that's the extent to which the market is divided between teams that are still operating very much on a product, along their product lines, and teams that are being brought together in order to be more solution selling orientated with their end customers. We see the market as broadly split 50-50. Without a huge amount of change in 2022. Very interested, Stuart, I know that you've had some changes in in Wells in terms of team alignment. Interested in if you could share the experience and let us know what the what the impact's been.
Sure. Thank you, Maurice. And good morning, good afternoon, good evening, depending, I guess, where you are. But yeah, I think it's interesting at Wells Fargo because I think where you started the conversation was that for many of the supply chain, programs or securitizations and those types of things, they had all been, for the last several years, been large corporate, right? Very large corporate driven. And in our parlance, we use the CIB vernacular for that. And what's interesting is that that's a pretty defined universe, right? Where you sit there and say, hey, you've got 500 or so large corporate clients that you're targeting, but so is every other competitor that we have. And we all started there, and then what we've seen is we've seen a shift, obviously, toward what I would call the upper end of the middle market, which we call mid-corp at Wells Fargo. And what's interesting about that is that the very time that we've seen a little bit of a shift in kind of the go-to-market, what we've also seen is that Wells Fargo is actually kind of now aligning its commercial bank into the same kind of product coverage model that the corporate bank has always had. And so we're going through that as we speak. And I think it gets to the point, Maurice, that you were making, which is historically, we always just kind of ran out there with product. Everyone had an individual silo and everybody kind of did their own thing, had their own sales teams, underwriting teams, portfolio teams, what have you, as opposed to now kind of stepping back from that, not only functionalizing those groups, but also looking at it more from a coverage perspective. And for our products, we definitely get into much more consultative selling. And so we find it ideal relative to this kind of change that we're making because it really aligns with our products extremely well.
A couple of questions on that. I mean, I'm guessing that has big impacts and the benefits for your relationship managers because they have to deal with fewer people. They can bring a kind of fuller view of what the product set can do. But how has the experience been in terms of kind of training and development, getting development of people? So getting the teams to be able to kind of grow into the various products. Has that been kind of easy, hard? Have you put a lot of resource against it?
We are working on that as we speak. I mean, obviously, for the last couple of years, we were really just focused on the CIB market and the large corporate market, I should say. And what's funny about that is, again, that's a pretty close-knit universe, very industry-driven. You can really align your stuff very quickly that way. You move into our commercial bank at Wells Fargo, and you could have 40,000 different relationships with 200,000 different employees that are focused on that. And how do you do that? So what we've tried to do in the mid-corp sector that we've really targeted, and when I say mid-corp, I think about it kind of the 750 million up to probably $2 billion. So if you kind of think about it that way, now for a lot of people that may be large corporate, but at Wells, that's how we think about it. And what's interesting is that's probably a universe of, let's say, 1,500 accounts, okay, at Wells Fargo. What we've tried to do is narrow that down into, what are the top 500 that we want to focus on, and then we've channeled our coverage people to that, and then depending on our hit or miss ratio and our successes. But what I would tell you so far, it's been fabulously successful, and to be honest with you, we're having a little bit of difficulty just keeping up with just the amount of volume that's coming through.
Good to hear. Always good to hear that. Maybe moving on to the next page. This is one that I guess not a question that we would have been asking before this year, right? Which is, are people back? And in terms of the survey results, we saw a lot of geographical variation. So I'd say, the Europeans sort of more towards the kind of fully remote or 1 to 2 days back in the office. North America, I think marching orders may be a little bit stronger, and variations in different places. I'd be interested if you could share, what the reaction or what the experience has been within Wells Fargo. And as we get back into, as we get into a hybrid working environment coming out of the pandemic, things that are, that we need to pay attention to from a kind of culture and performance perspective.
Yeah, I mean, from my vantage point, and again, I'm just one small wheel in a very big cog over here, but I would say this, you know, as far as our in office, as we now call it, you know, work environment, for us, we are a very small team. We have 180 people, and you know, and we're doing some very large numbers. So it's very, very difficult when you have a small team if you've got them dispersed everywhere. So what I find is that quote accidental learning, that I like to use the term, doesn't happen when everybody is remote. And I'm very worried about, you know, we probably have, I think we have 11 analysts right now of new interns and people have just come aboard. And I don't know how they would learn if they weren't in this environment. So for us, we've tried to bring people back, you know, sooner, and we've probably done it in again, because we're a close-knit group. But being mindful of the fact and being thoughtful of the fact that, you know, we need to create flexibility where we need to. And so it's actually not been so bad. I do realize that in North America, it's very different than it is elsewhere. And of course, I have the trade finance business at Wells Fargo. So I know what's happening in our offices in Singapore and Hong Kong and in China and things like that. So it's one where it's a balance. Let me just say that it's a balance, and we're trying to be thoughtful about it.
Yeah, and I think, you know, time will tell. Certainly here at Demica, we're in the kind of 2 days per week as mandatory, so to speak. And it's also interesting looking at how that impacts different functions. Like I remember when I used to run large-scale sales organizations, I would insist that they weren't in the office. You know, hardly at all. I think we made it Mondays and Fridays to allow people to catch up on their admin, but I wanted them in the field. Now a lot of sales is taking place, you know, this way. You know, you just, everything's changed. It'll take a while to settle down. Maybe we'll move on to growth next, and perhaps start with Eric. So we had a good discussion yesterday where kind of looking at the growth experience for the past 12 months and the outlook. Obviously, you know, to some degree, you ask, you know, a couple of hundred folk in the trade space whether they've grown and whether they feel like they're going to grow, and they're an optimistic bunch. So be interested, Eric, when you look at this, does it resonate? You know, where it doesn't, why it doesn't? You know, give us your perspective from a coalition perspective.
Sure. Thank you very much, Maurice. So first of all, very delighted to be here. And at Coalition Greenwich, we have the privilege of working with a lot of banks across the street. So we do have a little bit of view on what is actually happening in the supply chain finance world across different product spectrum. So first of all, I think I probably need to clarify on my position before I get kicked off to the room, right? I'm a huge supporter of supply chain finance as a product, as a legitimate financing, you know, tool for corporates managing their cash flow and working capital requirements. However, when I look at this chart, it still surprised me to some extent, right? I agree with the direction of travel. I think at the moment, less people expect in the next 12 months the significant increase of the assets. But I'm also equally surprised by how many people, the overall amount of people expect the industry to grow tremendously. I think there's two reasons for that. I think that a lot of people in this call are in the industry. So everybody understand that for the asset size of the industry to grow, it's coming from two sources. The first one is coming from banks. The second one is coming from buy side, either insurance, asset managers, pension funds, or hedge funds, etc. So at the moment, we see a lot of headwinds in both segments in terms of how much firepower they can deploy. So first of all, when you're looking at the bank's perspective, I think that everybody has read the news about, you know, there's a lot of deposit outflow, especially coming from the US dollar space. We see less so in euro or in some of the emerging market currencies. But I think the overall narrative is the liability business of the bank is actually most likely to decline this year. As a result of that, banks will, by nature, will have less firepower, say, how much assets they can grow. Because if you have a less liability, you will have less assets. This is how asset liability match works. So this is the first thing that will give me a little bit of reason to have a little bit surprised by this chart. The second reason is on the buy side participation. Don't get me wrong, we have data to show that in the past 10 years, I think every year, the buy side participation in supply chain finance assets has grown more than 30% a year for the past 10 years. I don't think that trend has been broken yet. But this year, we do see a lot of headwinds, right? I think the biggest headwind we've seen is how the macro picture had changed overnight because of what happened in the US banking industry. I think the reason why the industry has enjoyed tremendous growth last year is because nobody likes long-dated assets. People like the short-dated assets in the rapid rising cycle. However, now the narrative has changed. Everybody knows that. Jerome even said himself yesterday that they might have to pause a little bit in terms of how the Fed rates rise, which means that the buy side people are very smart people. They do very good due diligence on the assets they invest in. At the moment, a lot of them are talking about lock up the yield on the long-dated assets, because just in case in the next 3 to 5 years, there's going to be a lot of rate cuts. You never know. So the result of that, I think that the short-dated assets will lose a little bit of attractiveness in light of everything. As a result of that, I think if you think about these two reasons together, why I still expect that the asset size for the industry to grow, but our internal estimates suggest that the growth will be a lot slower rather than carry on as the 30% growth what we've seen in the past 10 years.
So I'll give a couple of observations and hand it over to Stuart. I think first is, to be fair to the survey, it was launched before Silicon Valley Bank, so it might look a little bit different just a couple of months later, such as the world that we're in. But my other observation is that trade as a percentage of bank assets, best we can tell, is kind of 1 to 2%, right, across the board. Obviously, it's different for some banks, so it's still a very small asset class as a percentage of bank balance sheets globally when you look at other asset classes. And some of the drivers of growth, inflation, secured products becoming a more attractive substitute for longer term, more expensive capital, is what's behind some of that growth. So the demand is there. Your question is, to what extent can the supply come? I mean, Stuart, to what extent does that resonate with you, and kind of what are you seeing that's similar and different?
Yeah, listen, I couldn't agree more. I think what's interesting, and I've said this from the beginning, and while I'm sure every bank has a different lineup of what their products are, we have open account products that are geared toward the large corporate side of the equation, and then I also have the factoring and some of the asset-based lending businesses that are more SME related, right? So you get kind of a wide swath, if you would, relative to that. And it's interesting to watch what I see happening, this kind of flight to safety, if you would, over the last couple of years, where people were concerned about whether it was the war in Ukraine, or whether it was the supply chain disruptions, or whether it's the rising interest rate. You had this real concern, and we saw a real shift of people turning into kind of these short-dated, self-liquidating assets, because they just didn't know what was going to happen. There was that uncertainty. And so that played right into our hand a little bit for our product set. And so that's been great. So I think all of our businesses last year, on the open account side, I think we're all probably 40+% growth rates in all of those sectors. So that sounds similar to what your numbers suggest. Trade finance, which is even, it's funny when you just think about, commercial LCs or standby LCs, or, even Swift trade loans, what have you. That's a pretty, that business kind of plods along, right? And to your point, it usually drives around anywhere from 0 to kind of the GDP percentage that you'll see. And what's fascinating, even that business for us last year was up, in double digit. And so that was kind of unheard of, but it kind of plays into what we're saying about this kind of flight to safety. So we've seen that. Now, having said that, I am the first to agree that I believe in mean reversion, and everything, will revert back to the mean. And so if you ask me in 3, 4, 5 years, do I think this goes back to, a business that grows 5, 10, 15%? Absolutely. So I think it's one of those that I think you just have to be kind of honest with yourself about what products you have. And the other thing I can also tell you is that there was a big difference between supplier finance, where you sit there and think that has a long cycle time, a long setup time, and then you got to load up, all the sellers and that type of thing, versus doing kind of a key account type of product where you're just buying, blocks of receivables and creating this short-term liquidity. I mean, the demand for that has just been unbelievable. So our growth on the cap side was much greater than the supply chain side, not because there wasn't a demand for it, but there was just a difference in the ability just to onboard these people and ultimately get them up and running. So it's just a different cycle time.
Yeah, no, that resonates. Let's move on to the next section, product. So looking at what we what we heard back in terms of, and I guess this is kind of building on the growth theme as to where the biggest drivers are. Again, Eric, when you look at these numbers, what looks high, what looks low, how does it contrast? And maybe you can give us some color with reference to different regions, what's going on in Asia, Europe.
Yeah, sure. I think that first of all, I think that Stuart already briefly touched on some of these product spectrum already in the past 2 to 3 minutes. So essentially, is I'm also in the same camp that payable finance, surprisingly, which has been the darling in the past 10 years, right? This year we actually see them being growing a lot less than our forecast to be. I think there's a lot of reasons for that, right? I think we're probably going to touch upon on that as well. There are, the changing FASB's disclosure requirements. There's also about the inventory to sales ratio for all the big corporates has probably had reached to the highest point towards the end of Q3 last year, which means payable finance as a product for buyers, they tend to buy less. So as a result of that, the utilization of payable finance year to date, we actually see the growth of that has slowed down quite significantly, which is a little bit different from, I would say, the past 10 years. It has always been a darling of the industry. As a result of that, I think, which is quite interesting, right? I think we still see, which Stuart also spoke a little bit on this as well. Receivable discounting has taken off very strongly this year. So it's still a working capital, type of product. You just have a different flavor about it. So we do see that a little bit sort of like, swap in terms of people's new favorites, darlings are. But it is still, from an overall industry standpoint, we still see quite a little bit of growth for this type of product, also if we aggregate them together. In terms of regional difference, I think that's quite a huge difference. I think that, especially, I'm based in London. If you think about Europe, what is their biggest market for is factoring. We actually see factoring in Europe at the moment is actually growing a little bit faster than what the numbers suggesting on the chart. I think that obviously there's a little bit different regional characteristics difference as well. So I think that from our data, we also see factoring being growing a bit faster, especially driven by the biggest markets globally in Europe.
Yeah, and I mean, I think the absence of the ABL product in France, in Germany, in Italy, in Spain means that you've just had this steady growth in factoring as it kind of moves into the mid-market and the upper mid-market, and that gets accepted. My experience through the global financial crisis is it gets accelerated in a downturn because alternative sources of funds, revolvers, start to be constrained, and you have kind of growth in that area. What's been interesting is to see in the US, this is our perception, Stuart, correct me, but you're seeing the banks come at that market because it really hasn't been driven by the factors. It's been driven by the banks from the top end of the market down, right? As they're starting to say, well, wait a second, if we look at some of our better rated commercial finance customers, maybe there's a blend in use case between ABL and key accounts, receivables discounting, and the securitization market's always had some level of activity. So structurally, it feels there's some room to grow and kind of tap space that hasn't been claimed by other players. Does that resonate with you?
Yeah, no, I think that's absolutely right. I mean, in the U.S., you have a clear delineation, right, between what's large corporate, what's middle market, and what's what we would call the SME market, right? And so I think here it's been that way for so long that everybody kind of plays in certain of those channels. So whereas in Europe, you tend to have, the SME market and the large corporate. There's not that real defined middle market. Now, I think that's changing to the point, but we see that very clearly. And so we've always kind of aligned our product sets along those lines, and how we go to market against those channels. We do the exact same thing. So it's, what I do see happening, though, is I think this uncertainty in the U.S. relative to banking in general, to some of the points Eric had made relative to what's happening in the banking market just recently. I think it's really got people focused into things then and actually raising the concern level that we're seeing a pickup not only in our factoring business but our asset-based lending business, because once again people are going to that safety valve, if you could, and that's playing out well for us. But I think that's a point in time. I don't think that's a long-term type of scenario, but this delineation in the marketplace. But like I said, one of the things that I think is helping Wells specifically, and in the U.S., I mean, we compete with the top 4 banks in the U.S., is that Wells has a very, very defined middle market presence, right? Probably larger than others where they may have a larger corporate banking, presence than we do. And so as our products shift down into that segment, it has been really helpful for us. So today I would say, 2 years ago, our pipeline was probably 90% large corporate to 10%, middle market. Today, we're actually seeing it to be 50-50 today. So we're actually, as we educate and as we get our products into the middle market and they start to see the benefit of those, then we're seeing that the bankers are starting to introduce us to all of their customers as well.
And what about dynamic discounting? So that was obviously in a close to zero rate interest rate environment. We were all looking for places to put our money. That explains to me some of these esoteric asset classes that arose, bitcoins and the like, crypto. The world's changed and corporates have got to be more cautious around kind of use of cash. So not that it's going away, because I think some of the tools that have been deployed into the market are of good quality and give corporates flexibility. But the growth rate on that product, and this I think is, relative growth rates, not absolute growth rates from the participants, but you think dynamic discounting, calibrates in this market, whereas others, may have opportunities to grow.
I can just give you my view in North America, and Eric can tell us what's happening elsewhere. But what we saw is it came out of the box very hot, and I think there were, and this is the same thing in supply chain, right? The funny thing about supply chain to me early on was it was actually, designed for kind of the, cross-border industrial type of companies. But the first people that grabbed the product happened to be the large retailers, right? Which always seemed interesting to me of why they went there, which was fine. And then ultimately the auto parts and then ultimately the auto manufacturers as well, got on board. Well, I saw the same thing happen in the dynamic discounting. It was funny because there were some very large retailers that, jumped on board with dynamic discounting like Costco and things like that. And now what we've seen is that's kind of tailed off a little bit and it's kind of quieted down a little bit, but that may be more born out of the fact of what's happening just today in the last 6 months. Versus long term. I love that product, and I think that dynamic nature of to your point of corporations being able to use their cash more efficiently is just another tool in the box. So yeah, it's kind of slowed here a little bit just recently.
I think that's right. I think, and often with these products, what gets sold sticks. So it's the new business acquisition dynamic that changes, and some accelerates in the short term and some doesn't. Maybe we'll move on. So, there's been new disclosure rules on payables. The survey results are interesting in that you had half the market saying that they didn't expect much change to demand, and then the balance split between those who think that the increased disclosure helps and those who think that it'll diminish, right? Eric, again, turning to you, I'm sure this is something that you've talked to, banks quite broadly on. What's are you in the blue or the red box?
It really depends on which day you ask me on that question, right? I think it's right to people have different opinions. Actually, I'm not surprised by this chart at all. I think in terms of how people feel about it. Why? It's a new thing. Nobody knows what's going to happen. It's natural for human beings to feel nervous about something they don't know of. So we have had a lot of conversations with banks. We also, through our voice of customer survey, spoke to some of the corporates on this as well. I think it's true that there's a lot of people feel nervous about it. I think what is the reason for the nervousness is because we are still not there yet in terms of how do we have the full transparency of everything. What I meant by that is all of this requirement is on disclosure. It's not on accounting treatment. This is where all the discretion can be imposed on any sort of thing, right? So as a result of that, there's a lot of scenarios we can think of. So for example, what if one corporate simply just say, I don't want people to know how much program financing I use with supply chain finance. There will be another corporate says, what if I think this is a trade payable and all my auditors and all the equity analysts think this is debt? What am I going to do? And the third case would be, I compete with a firm which is not in the US. They have different accounting standards. What if, in my case, it's debt, in their case, the trade of payables? Now, equity analyst is going to punish me for nothing. This is something they don't want, right? This is why I think there's a lot of cases we've talked through. I said that if someone are interested, I can send you the list of 100 different scenarios we discussed with everybody in terms of why people are nervous. I think there's a reason for that. So the result of that, I think the next question is what we can do about it, right? Collectively, between us and all the people who have joined this webinar, I believe we are the driver voice of this industry. I think we've done the first round of things we need to do. We all participate in the FASB or International Accounting Standards consultation round 1, round 2, etc. I think the next thing is, how do we educate the auditors, equity analysts, credit analysts, so that we can form some sort of consensus on accounting treatment? This is, I think, it is the key to make sure people are not nervous about this anymore.
Yeah, I think those points well made. I don't know, Stuart, whether you've got anything to add to that, where anything kind of resonates in particular within wealth, in terms of what you're hearing from customers.
I would just say in North America, my experience is that, listen, we all welcome full transparency and disclosure. So it's one of those that, as we would say, that's like, do you love your mother, apple pie and Chevrolet, right? Yes, the answer is yes. And so I think it's pretty straightforward where, we're not, when we sit there and look at taking terms from, 30 days to 90 or 120, we don't really get involved on the supply chain side that's that big a difference. Where I think this came about was there were some bad actors early on that started to try to take, what I would have called short-term payables or short-term receivables, whichever side you're on, and tried to sit there and take them out 2 years, 3 years, and it started to look like project finance. It started to look like, milestone billing. It started and you're like going, guys, that's not what we do. We're not in that space. We don't really get tied up in that. And I would also tell you in the U.S. for the large corporates we do business with, it's such a small portion of what they do overall to their overall capital structure that it really isn't. It really hasn't been an effect here. And then as we move down into the middle market, those are all privately held companies, so they don't get caught up in the disclosure type of nature as the others do. So I haven't seen that. The thing we spend the most time on is whether true sale treatment has happened in our securitization or whatever, and what the accountants treat there. But relative to disclosure on the payable side, that it really has not hindered us over here.
Yeah, no, that resonates. So next, I guess the next is down to kind of challenges for receivables teams, and expanding addressable markets a pretty broad. That's a pretty broad definition of a challenge. I think that broadly, from what we see, broadly banks are more constrained rather than kind of relative to history in terms of expanding geographically, and they're very much following their customers, and that's a shift. So whether that stands behind why those concerns may be there. Monitoring and reporting is an interesting one, because certainly from Demica perspective, we about 2-3 years ago decided to shift some of our CapEx focus. We built a very kind of robust and kind of modern payables finance, supply chain finance tool, and we started to shift our attention to receivables. And we did have some folk tell us, why are you doing that, right? That business doesn't need a platform in the same way, right? It doesn't have the supplier onboarding and the same payments, onboarding and payments requirements that the payables product has. And our observation was that's true, but there are plenty of other inefficiencies in terms of how data arrives from your customer, operational risk, reporting, and deal structuring tools that can be deployed into the product. So it's interesting to see that one come up. Those are the certain things that come off for me. I know, Stuart, risk distributions are a subject close to Tia Hart, be interested in your views on that one.
Yeah. No, I think the two things that you named is exactly, I mean, the two things are truisms, right? If you're loading this much business onto your system, you know, how scalable is your system? How is the reporting out of that system? And then for us, we found from an operational standpoint that obviously the more things that are not digital or the more things that are not automated then become manual, and the more manual becomes more exceptions, and exception handling, as we know, leads down a bad path, right? So we've been very, very focused on the operational side and the automation side from that standpoint. But to your other point, which is at the same time you're loading all these assets on, the question is, well, just how much are you willing to hold, right, becomes an issue. And I think Eric touched on an issue that was interesting in that the U.S., especially in the U.S., both the capital methodologies and capital allocation and what's going on there has really had, you know, everyone take kind of a step back of just, you know, how are you going to deploy your capital into which deals? And it's become very deal specific and very strategic in that nature. If at the end of the day you start to move to more of an originate to distribute model, then you better have something that's really automated or something that you can distribute this risk pretty effectively. And I think that's where, you know, a lot of the teams in the U.S. are all shifting gears into that to become better at that. A lot of us do it the kind of the old-fashioned way, right? And that's not ideal either.
Yeah, no, we often feel that one of our people ask me who our main competitors are, and I say, you know, a Microsoft Office with Excel seems to be one of the. It's a pretty efficient tool, right? But it has its limits vis-a-vis kind of scalability and product refinement. Eric, you know, when you look at this list and you speak to folk, anything that jumps out?
I think I couldn't agree more, right? I think this is the pecking order I would give on some of these key issues as well if I voted myself. So I think that especially the first one, I think this is actually very interesting itself. I know we've been talking about supply chain finance or receivables for years, as far as I remember, for the moment I stepped into this industry many years ago. But still, the penetration of this product varies significantly market by market. I think this is a very key thing to take into consideration, right? I think there's a huge adoption following COVID. I think COVID was an enabler, made a lot of this market historically very resistant to this type of products become easier to accept it. But still, when we're looking at all the countries globally, everybody probably know that US is very well developed in terms of most of the corporates will use it. In Europe, everybody probably will tell you, say, it's also very developed, but actually our data suggests, well, not really. It really depends on which country you are talking about, right? When you're comparing Spain versus France versus Germany versus UK, there's a huge divergence in terms of adoption rates of the receivable products or the payable products. Generally speaking, obviously, most of the markets since following COVID actually experienced quite a big jump in terms of adoption rates. Italy actually experienced a decline. So there's a lot of different things we're talking about. Obviously, then we're talking about more emerging market in Asia, in Middle East, in Latin America. We see the adoption rate is going up the roof at the moment. So this is why I think I couldn't agree more. Right? I think expanding addressable market, educating your corporate clients in different jurisdictions, how they can utilize these products is probably the paramount, things we should consider at this stage.
Yeah, I mean, one of the questions that's come in is why do we think that payables finance has been the product that's historically driven the highest growth? My perspective on that is, it's a new product, and particularly in the US, it was very competitive relative to factoring. In Europe, it's still competitive relative to factoring, but not to the same degree. I mean, the take-up rate for smaller suppliers and the pricing was much higher. And I think for larger suppliers, it became part of the procurement process, right? So it was just penetrating the market in a very different way. It sold in a very different way, and therefore it drove the growth of the market. So there was some product substitution, but it drove the growth of the market. And it's still running. The question is how long it will run for, which we've covered. So that would be my take on why it has been higher growth relative to receivables, which has tracked a sort of smaller multiple of GDP over time, depending on the market that you're in. And I think we've covered that in pride in
But
our
Maurice,
discussion.
also don't forget that the other thing that makes it very attractive is almost it's kind of the dichotomy between who you're facing off to, right? So if at the end of the day you're facing off to a large retailer whose credit quality is extremely high, then the pricing on that becomes far less. So what we saw was a dynamic where you had kind of a trade between doing an asset-based loan that may have been at a 250, 300 spread, and versus going to the retailer that maybe was at 75. So you created that dynamic between the pricing, and that at first really drove a lot of this at the beginning. So that's what we saw.
Absolutely, but I remember back in my GE Capital days, some of the biggest debtor exposures of the French and German factoring businesses were Lidl and Aldi, right? And they were very finely priced, right? So the bar that you had to cross was a little bit different for a confirmed payable. I think in the US just had a different dynamic. But certainly the methods of delivery, the channel, the way it was sold, and that cost differential just, I think, played out in different places and continues to do so. To me, the big question going forward is, as you get out of investment grade territory or into crossover and sub-investment grade, does that market kind of growth continue, or does it slow down because the arbitrage that you reference starts to become tighter?
Well, and I think what you get as we've watched ourselves move into the middle market, we've had to come up with structuring things, right? That you no longer just looking at things like you would have done on an unsecured basis, and so you look at that. But if you can pick and choose who the debtors are, then that ultimately, because again, you could have a smaller buyer, but the suppliers could still be very large, and so that we see that a lot. And so listen, I think it's good for some things. I'm not sure it's good for everything, right?
No, agreed. Let's move on.
Yeah,
Dan.
Couldn't agree more with what you just said, right? I think the arbitrage window has narrowed quite significantly.
Yeah. And I think there are plays where the arbitrage window narrows. You just have to be more creative, and it becomes more sector specific. I mean, there are still segments of the market where the cost of capital for certain suppliers is very high and higher than what would be obtainable by a double B rated name. Yeah, ESG's got a lot of attention. Our observation is that there's been some increase in the only tangible measure of usage that I can find, which is the usage of ratings. So if 23% of our audience say they are using them, means they are using them. How much volume it's driving, we're not sure. But that's a big difference from last year, which was, I think the number was sort of certainly single digit. And then what I find particularly interesting is the difference between, kind of banks who say they're doing more, or they're reducing their limits on non-ESG friendly sectors, and we do see that. And some who say they're increasing, right? Because there's a financing requirement, right? People still want to put petrol into their cars and heat their homes, and with kind of rising energy prices comes an increased requirement. So I think, I'm sure, Stuart, it's topical, and there are real initiatives being put into play. But to me, this is something that plays out over a long period of time.
It's early in the game. It's very early.
Early in the game. Yeah, I think that's right. So we've got some, which we'll go through quite quickly, so we can leave time for some other questions. We've got some talking points on technology, which I'll go through reasonably quickly. So in terms of what banks are looking for, I think pots and pans, right? I've just replaced telecoms to trade from when I was a TMT banker, with the difference between plain old telecom systems and pretty amazing new stuff. So the pretty amazing new stuff acronym still works. But what we find is that there's just a need to upgrade some of the basics, right? Before you get into artificial intelligence and kind of blockchain-enabled solutions and robotic process automation, all of which are interesting and have their cases. But what's needed today, what the survey tells us, number one, is more operational efficiency. Get your customers to self-serve. Get your risk department off their preoccupations and concerns, so you can do more business and improve the customer experience. So I think there's some pans that you need, right? If you're just replacing what you've got, that's not good. But it's it's a combination of the two. Maybe move to the next one, then we can kind of have some more discussion. And then, you know, this shows when banks implemented their existing solution. So, you know, not a surprise to anyone, I'm sure, on this call, that there's a lot of aged technology out there, and when the replacement is expecting to happen. And we're seeing this in terms of continued RFP activity. So we had a huge amount. It was interesting, after the pandemic struck, we were sitting at home worrying, right, like everybody else, about what would happen next. And actually, we saw an acceleration in the level of RFP activity and procurement activity, because I think the overall, you know, realization that an investment in digital was, you know, was not going to diminish because of the pandemic. And so that's continued. You know, in fact, in the past quarter, we've had, you know, 5 new RFPs in large-scale bank projects that we didn't see coming. The others, you know, we were close to the banks involved, but we didn't see them move into action as quickly. So that continues. And then finally, before we kind of put it over to some questions, on the next slide, we've got kind of how banks are using their technology, right? You've got some banks that kind of are very much origination, owning their own origination, and therefore they want one platform for substantively all of their transactions. And then others are looking for platforms to bring them functionality so they can service clients or bring them deals, right? Depending on what the client needs are. So I see quite a, yeah, there's room for everybody in this space, right? We're sort of more towards enabling origination, so banks can control their own origination. So that's kind of what the survey told us. I know, you know, Stuart, you must kind of look at this, and you're obviously reviewing decisions around kind of investment all the time. Anything we've missed, anything that resonates with you in particular?
No, I think that's right. I think, you know, listen, the banks are spending a fortune on infrastructure that you mentioned. They're spending a lot of money on kind of the customer experience, right, and the front end of that. Then you're driven by the lines of business looking for efficiency plays, right? You know, how do we make our business more efficient? And then finally, I think, you know, there's it's like keeping one eye open when you're sleeping, is watching what all the large technology companies are doing, you know, relative to wanting to merge into your space. And the question is, who do you team up with? And I think that, you know, I heard a speech last week that was is the way I think about it. There are certain things that I think that you want to work with others on from a, you know, from a utility standpoint, whether it's the technology companies or even your competitors. And then there's things that really differentiate your, you know, your bank, in my case, to another bank, and that you know, you don't want to disintermediate yourself between you and your customer. So I think it's all of the above, but I think you hit the nail on the head.
Great. Well, I think those were some of the observations we were to run through. We'll just look at questions. So we've got a question in around the activity that is Demica seeing demand vary by region or by type of bank? And it's an interesting one, because what we're certainly seeing the large banks that we deal with wanting to serve them in different locations. So you've got kind of projects that are running across Asia, Europe, North America, and that's what's taking us into different markets. And then we've got, you know, some activity in markets that we really haven't, we didn't anticipate. We've got a lot of new customers in the Middle East, where I didn't think kind of payables and receivables finance was, I mean, it was a very nascent market just 5 years ago when we started, who have ramped their books quite quickly. So it varies. Another question, how will the trend in procurement from just in time to just in case affect the market for AP and AR, and will it increase reliance in inventory finance? Stuart, maybe one for you to kick off with.
Yeah, I mean, you know, it's funny. That's exactly right. It went from just in time to get anything you can now, right? And so then what's happened in the U.S. is everybody loaded up on inventory, and now we can't find warehouses or ships on, you know, put inventory in. And now all of a sudden you've got 2 years worth of supply that's got to work its way through the chain. And so it's one of those things that is the balance between how you kind of clean out the old to start focusing on the new. And right now it seems like a lot of the companies we deal with are so focused on just what's sitting in front of them, as opposed to looking out what it would be in 3 to 5, 10 years. And so we've seen that trend. And so I don't know if I answered the question, but it's funny that in North America right now, we've got an inventory glut at the very time that you're looking at potentially moving into a recession and a slowdown. and we're seeing the margins come down significantly because of that.
Eric, anything, inventory finance has been a, kind of hot topic of discussion over the past couple of years. It's not a new phenomenon, but it certainly got people's interest raised and new credit funds coming into the space with clever new structures. Do you think it's transitory, or do you think that this is a trend worth backing?
I think, first of all, I agree with what Stuart and said earlier, right? I think that you, as a large corporate, you can't just keep on buy. I don't think that is the solution for any corporate at the moment, if you think about the profit warnings everybody receive. So as a result of that, it did lead to explosive growth in inventory finance, which is very true. So I think our data verifies that when we're looking at inventory finance as a product spectrum in the working capital management, has grown tremendously in the past, especially in the past 2 years. It's just because there's a bigger pool of inventory people can play with. That is one of the biggest drive of that. And in terms of whether it's a long-term thing or a transitory, is very hard to say, because these products did remind me of, about 15 years ago, what was supply chain finance is about, right? I think this is exactly 15 years ago when we started the conversation about supply chain finance. But also, I think that these products also carries a little bit difference in terms of the characteristics comparing to a typical supply chain finance program. So I think that I'm quite neutral actually in this case. So only time can tell. Maybe next time, a year later, we can do a rerun of the events. We can tell you guys whether inventory finance has slowed down or not.
No, I was pretty non-committal, Eric. It's not like you. I'd expected you to. Stuart, question for you: as the regional communities fail and deposits flow into the big four banks, is your cost of funding trending lower? I don't know whether that's from a prospective customer, but what's your?
Yeah, and listen, I think it's maybe the answer to that is too early to tell, right? This has all happened in the last 3-4 months, so I don't know the answer to that. What I will say is that there is a much heightened awareness of how banking actually works, and how those that are large deposit gatherers are different than those who go out to borrow money in the marketplace to fund their businesses. So time will tell whether one's right or wrong. I just think that it's raised the awareness of that, and I'm fortunate to work at a bank that obviously is a large bank that has a large balance sheet and that type of thing. But listen, we're the first to sit there and say we want a healthy banking system across the board. So there's no advantage to sit there and say one's better than the other. It's just, that's not ideal for anybody. So because I'm also the very person that told you that I need more syndication abilities to lay things off to other people. So I'm all about liquidity in a marketplace. I can tell you that.
And my experience of working with treasury functions is a bit like buying petrol. When the cost of oil goes up, suddenly you get a hike in the in the price at the pump. When it starts to come down, strangely, it takes a while to work its way through the system. So to your point, I think it's early before we see that happen. So look, great discussion. If there's a last question to come in, happy to take it. Otherwise, I want to thank Stuart and Eric very much for giving us the time. We know you have very busy schedules and lots of demands for these types of things, so appreciate it. And thanks to the folk who have dialed in to listen. So with that, I'll close the webinar. Thanks very much, everyone.
Thank you.
Cheers.
Bye.